Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, Tuesday, May 27th, coming off a long Memorial Day weekend where markets kind of sputtered and then, of course, shot right back up as soon as the U.S. equity market opened, because that is what is driving crypto these days. So I am joined by my partner here at Arca, Jerald David. Jerald has 20 years of experience in financial services. He's president of Arca Labs, which, for those who don't know, it's Arca's innovation arm. For the past 6 years, he's been quarterbacking the creation of our first 40 Act fund, which was used to issue shares as digital asset securities, called the Arca U.S. Treasury Fund. And now Arca Labs, along with Tassat Group and T0, are launching LYNQ, which is a pretty cool product company. Real-time yield-bearing settlement network powered by tokenized Treasury funds, custodied at special purpose broker-dealers, and JD has been appointed by the CEO of LYNQ. So JD, thank you for joining.
Awesome to be on the show, Jeff. Thanks for having me. And I can't believe it's been 6 years. It's pretty crazy, right?
I know, it's been a long time, pal. Before we get into your stuff, though, and for those who've been here every week listening to what we do, obviously, we write a blog every week on our website, ar.ca/blog. It's called That's Our Two Satoshis. This week, I wrote a lot about pretty much the fact that there is no such thing as alt season anymore. If you're looking for alt season, it ain't going to happen. This is now a real market with tokens that are being driven by revenue and real fundamentals. This idea of all this nonsense, things that you've heard about for the last 7 years, finally, it doesn't matter anymore. Basically, tokens are just stocks for the most part, outside of Bitcoin and a few others. And it means you need to have revenues, and you need to have profits, and you need to do something that makes the token have value, usually in the form of buybacks or dividends of some sort. So we talked about Hyperliquid and Radium and others, and why these are the ones that are driving the market higher right now. DeFi clearly growing. Just been a pretty good 6 weeks now for the market in general, but specifically around these profitable tokens. So read the blog if you want to see that. Also, ho-hum, Bitcoin hit all-time highs. No one cares anymore. That's just what's happening. What's interesting, though, is that, as most of you probably know, the market really is moving away from what it was like 4 or 5 years ago, where it was very crypto native. Right now, you've got everything from real-world assets or RWAs. You're seeing a ton of tokenized treasuries coming out of BlackRock. You're seeing things like HELOCs being done on the Figure or Provenance blockchain. Obviously, what's happening with Bitcoin ETFs and soon to be other ETFs. You also have all these public companies now that are putting Bitcoin and other assets in their treasuries. Some via SPACs, some via reverse mergers. There's going to be the Circle IPO probably coming this week or next, as well as a lot of M&A. So you can see where we're going with this. There's a lot of things happening outside of just your DEXs and your kind of crypto native on-chain world. A couple of weeks ago, we brought in the guys from Galaxy, Alex Thorne, talking about the Genius Act. We had a lot of good feedback on that, people wanting to know more about this sort of outside world. And it's a good segue into why Jerald's here today to talk about another initiative that really is going to be driving the sort of intersection between traditional finance and crypto. And I think it'll be really interesting to hear about what LYNQ is, why we're doing it, and sort of what that bridge is as we kind of further this intersection between TradFi and crypto. So JD, without further ado, let's dive into it. Like, what is LYNQ? Why should people care? What's it going to do for crypto? Go ahead and cook.
That's awesome. Thanks, Jeff. And again, appreciate you being on the show today. It's kind of exciting to share more about what we've been building in the background. And it is crazy to think that the journey really did begin, kind of some 6 years ago, when at Arca and Arca Labs, the innovation arm, we were thinking about what tokenized treasuries could look like. And back then in 2018, 2019, it wasn't like we were talking to the SEC about what blockchain it is we're going to develop on. We're talking about the merits of blockchain. And through the learnings that we had over the course of, those 2 years, and that fund itself specifically went effective on July the 6th of 2020. Which is some 4 years before, some of the bigger names that came into the space that started creating similar products.
I remember going to Washington, D.C. with you, I think, at the end of 2018. I mean, this process was a long time ago, trying to get into the SEC, talking about, basically just for those who are listening, like, there's always been two use cases for crypto, right? There's crypto, the asset, right? The investment asset. And then there's crypto, the technology, which is really just a wrapper that can house any asset, right? The analogy I always use is it's no different than an ETF, right? An ETF is just a wrapper, and you can put anything inside of it. So while our Arca investment management arm was always focused on crypto, the asset, and how we can invest and generate returns for investors in these assets, JD and his group have been focused on crypto, the technology, and really pioneers in this industry with regard to tokenized assets. And again, this intersection. So sorry to cut you off, but you're right. It's been a long time coming, kind of some of these initiatives you've been working on.
It's absolutely correct, and our thought was back then, and it was informed a lot by, kind of the experiences that a lot of the, senior management at Arca had previously, was that these investment vehicles, these pooled investment vehicles, ultimately have a delivery mechanism that could create enhancements and ultimately mitigate risk. So through the learnings of the Arca US Treasury Fund, there were a couple of things that were pretty clear. The first was that we were ahead of our time. That's the first thing I'd acknowledge. And, kind of that, is, a testament to, the vision that we had. But the second thing I think that I would say is that we learned that although we did create some really cool enhancements to that product, this is the only one that's still permitted to trade on an ATS, right? The Arca US Treasury Fund, pretty cool. Can be traded peer-to-peer unencumbered on a blockchain. Again, kind of that is different than the Franklin Templeton, the Wisdom Tree, and the BlackRock iterations of the product. But one of the other innovations that we had at the time was that we actually
slow down on that. So the Arca US Treasury Fund can do what that the BlackRock and Franklin Treasury Fund can't do?
It can be transferred. It can be transferred peer-to-peer based upon a whitelist, and not a digital asset security transfer agency that ultimately has to go out and approve each of those different transfers that takes place. So some significant differences. But I would say that one of the coolest innovations that we had back then, and you'll remember this, Jeff, we aligned ourselves with the team at Signature Bank. And whereas for 40 Act funds, the prohibition on actually accepting subscriptions to the fund is anything other than an ACH or a wire. And back then, we had worked with the Signature Bank team to allow for subscriptions to that fund specifically to be via a Signet, which is a tokenized cash deposit. Mm-hmm. And that was really, really revolutionary at the time. And then obviously we know what happened in 2023 with the banking crisis. And ultimately that system was decommissioned as part of Signature Bank ultimate bankruptcy. So, kind of through that learning of Signet, we found out and realized, how important that technology was infrastructurally to the marketplaces, right? And Signature Bank was used, for a lot of things, but most importantly, the Signet system was used for settlement in between industry firms in the digital asset space. There were over 2,000 different clients that were onboarded to that platform. Over 600 had actually connected via API. And unfortunately, when that went away, I would say that the settlement rails that the industry had become accustomed to, at least in North America, were taken away. And I think that, even we think about, what's going on over at Arca Investment Management, our operational team, since that point, struggles with having to, settle transactions in a uniform way because you've got bespoke settlement processes that happen based upon any counterparty that you're dealing with at any given time.
Well, and a good example of that, I mean, just think about what we do. We seamlessly go back and forth between trading stocks and trading crypto. And, here's an example. Let's say we own some Bitcoin in a fund and we decide to sell that Bitcoin. Typically, we're selling it through some sort of, broker or exchange into a stable coin like Tether or USDC. Then we have to take that Tether or USDC and we have to go through Circle or some other counterparty to exchange that into dollars. Then we have to take those dollars and we have to wire it to a bank. Then we have to wait for that to settle. Then we have to take the money from the bank and wire it to a brokerage account. And then from there, we have to wait for that to settle. And then we take that money in the brokerage account and we buy a stock. And that's usually a T+1 settle, right? So and of course the process is reversed the other way as well. We're selling a stock into dollars, take the money out of a brokerage account into a bank, from a bank into, Circle or some other intermediary to turn it into stable coins, and from stable coins into crypto. So it is a massive amount of steps that could certainly be alleviated. And that's just one example, right? I mean, there's tons of different entities throughout crypto that are trying to figure out the same way to basically get money in, money out.
And that example you're bringing up there, irrespective of how many hops you're talking about, just talks about the inefficiencies that exist between the traditional U.S. banking or the international banking system and digital assets. And that gap in time and transference introduces risk. And that's one of the things that we're trying to solve for essentially with LYNQ. So LYNQ, Jeff, as you asked kind of a few minutes ago, is a broker-dealer facilitated real-time settlement system that was created in partnership with both Arca Labs, with Tassat, who is the actual creator and the technology provider for Signature Bank Signet, and also ran Cubby for a significant period of time. And a broker-dealer here in the U.S. that's called T0 Securities. They're one of two special purpose broker-dealers that exists. And this combination of both the tried and tested technology that Tassat provided and the regulatory licenses and a fund that was created by Arca combined now are what's being used to power LYNQ.
So you've basically been in stealth operation now, heads down, right, for a couple of years here. You're kind of emerging from stealth mode. You mentioned T0, Tassat. Who else is involved here? What else happens next with regard to the launch here?
Yeah, totally. It was fun. About a month ago, we finally announced after almost a year and 3 quarters being in stealth mode and having almost 90 NDAs in place with market participants and knowing that nothing had leaked. So it was pretty cool when we got to announce the business. And upon our announcement, we announced 3 of the core partners that we had been working with in conjunction, with creating the business. They were helping us to understand what the specifications needed to be, but more importantly, are committed to being there on day one with us when we launch. And that is B2C2, Wintermute, and Galaxy. Really 3 stand-up names in the marketplace, of whom we're so appreciative to have partnered with and worked with. We followed that up with the announcement of our first anchor exchange partner, which is crypto.com, and they too will be there upon launch. And the beauty of that relationship is it allows for any client that is on the Link platform to on-ramp to their exchange. So basically, you can fund an account using collateral on our platform in order to gain buying power on that.
So can you say that for a second? Like, walk through an example of like how this would work and what this is streamlining, right? Like, I gave the example of sort of the inefficiencies between going back and forth between stables and brokerages. Like, how would this affect a crypto.com client, or in the future, if there's other brokers and exchanges, like what's an example of how this would work?
Absolutely. And I think that to think about this, you've got to understand a couple of who the other partners are around the table. So we have a banking partner, and that's the banking partner to the broker dealer, and also to the fund. So, kind of breaking this all down, what ends up happening in the background is clients will onboard to the special purpose broker dealer. They'll fill out AML KYC. This is a regulatorily compliant platform. We do inline AML KYC monitoring. There's record retention, all the things you'd expect to have from dealing in that infrastructure. Once one's actually onboarded to the broker dealer, they send funds to the broker dealer's bank account at US Bank. Those funds then are deployed. We've got 3 different partners that we're working with right now for Treasury procurement: Hidden Road, RL Partners, and Cantor Fitzgerald. The 3 of them will actually then go ahead and manage our treasury needs in accordance with the way that the PPM has been written. And there's a PPM that's out there because Arca is operating a private fund. That private fund has a mandate to invest in treasuries. And ultimately, the client that subscribed to the fund is the one that onboarded the broker dealer. And ultimately, they find themselves in recipient of shares of that fund. You with me so far?
Mm-hmm.
So those shares then, once they hit the special purpose broker dealer's custody solution, are replicated on the private permission blockchain that's operated by Tassat. And those interests of that fund are moved back and forth. They have a NAV that's always struck at $1. They're interest bearing at all times. Interest is accrued daily and distributed at the end of each day. And we've also created an algorithm, Jeff, that allows for us to go ahead and allocate that interest down to the 2-second block.
Okay, so that's a big deal, right? So basically, we've talked about stablecoins forever and how, really it's the intermediaries who get all the money. Here, if I own Tether or I own USDC, I'm not getting any interest, whereas the companies behind Tether and USDC are taking all of that float because they're the ones investing in the treasuries and making the money. You're saying here a big difference here is that these are interest-bearing tokens.
That's right. So because they're a share of fund that's invested in U.S. Treasuries, shares of that fund generate interest. The interest is redistributed back to the clients that invested in the fund. And even more so, rather than receiving a check, or something quarterly, we end up receiving this in kind at the end of each day around 6:00 p.m. Eastern time. And like I said, we've got a patent pending algorithm that we refer to as yield in transit that allows for us to allocate that yield back down to the user to the 2-second block.
So it doesn't matter if you own this for 5 minutes, 5 days, 5 years. If you own it and you are time stamped as owning it, you're getting the interest, right? I mean, for those who don't really know how banking works, 100% of banking is just who owns the float and how long can you own it, right? The whole, there's a myriad of financial institutions that build their entire business line simply by, if we can own the money for a short period of time and earn the float by investing in treasuries or CP or whatever, we're going to make a lot of money, right? So essentially, you're eliminating that part of this, and essentially that float is going to the owner of the asset rather than the intermediary behind it.
That's it. And you go back to the example you were talking about earlier, Jeff, and you've got that back and forth between all sorts of different, kind of acceptable forms of collateral that are used in the marketplace. The goal here obviously is to centralize all of that activity in one platform, whereby you can on-ramp to an exchange, you can transfer peer-to-peer with your counterparties in the bilateral market. You can then ultimately send it to a stablecoin issuer who can mint and redeem on platform. Talking to the ETF providers right now about how it is that we could streamline their processes, that they can amend their S1s in order for us to allow market makers to go ahead and send that quote unquote cash leg via T-Fund tokens on our platform in order to streamline that process and really cut out, what's T+3 currently. So there's a ton of different use cases that we're working with. We haven't even talked yet about the relationship with Fireblocks, right? Whereby from Fireblocks now, with the announcement we put out last week, and the integration we're working on right now. Over 2,000 of their clients will be gained access to our platform and can actually access it via their GUI, the Fireblocks GUI as well. Mm-hmm. So there's a whole bunch of different initiatives that we're undertaking right now in order to, kind of coalesce the industry in one place to solve for the fragmentation that has existed, really since Signature Bank and Silvergate went away.
So, I mean, you mentioned Crypto.com, Fireblocks, obviously others. I mean, is it too late for others to join the network? Or like, do we need every single participant in crypto to eventually be on this network? Or will it work even in a fragmented form in the beginning? Like, how do you solve that problem?
Yeah, so we currently have, and I think the number is somewhere in upwards of 30 different market participants that are in various stages of onboarding at the broker-dealer. So have received their application, may have not been approved yet, maybe doing AML KYC. But the goal here really is for us to get as many market participants on platform for our commercial launch and then soon thereafter. I think that it's pretty clear from our discussions with the dialogue that our discussions with the industry, that what we're creating is something that the market has been after since Signature Bank and Silvergate went away. So although, we may not be signing up every single market participant that's out there, that certainly is the objective. It's to start within this space right now. And just to give you an example of kind of the creativity that we've got in our thinking, there's no reason why, and we're having conversations with several of the leading FCMs in the digital asset space, whereby clients can be funding their futures accounts via this platform. Now, don't get me wrong. I'm not saying that T-fund shares of this fund are going to be acceptable at the clearinghouse at CME. But the FCM themselves has recognized that they can allow for this to be acceptable forms of collateral to be posted with them for IM, and ultimately then they could use cash or treasuries or whatever else is acceptable at the clearinghouse in order to make it easier for their clients to access markets and to make sure that those transactions themselves are as time efficient as possible.
Yeah, so a big part of what we're seeing in crypto is that I've always said that a lot of the products in the last few years have kind of been one step forward, two steps back, meaning like the ETF is great for the price of Bitcoin, but it's actually going the wrong way. For example, right? You're taking this great on-chain asset called Bitcoin that is real-time settlement, and you're instead jamming it into this antiquated T+1, rails rather than going the other way, which is taking things like stocks and bonds and moving them onto crypto rails, right? Does this solve for that? Like, is this what, looking at all the things that we've seen now in crypto, and again, all this sort of TradFi integration, where a lot of it is really catering to the broker-dealer world, but maybe removing the benefits of what crypto really is, which again, being kind of a real-time settlement. Does this help us move the other way? Is this more of let's onboard the TradFi banking brokerage world into actual crypto rather than bringing crypto to the broker TradFi world?
Yeah, I mean, I think of this as being, kind of something that the digital asset market has already, kind of voted on and said that, kind of this is something that we need. And I think that through the regulatory compliant patchwork of licenses and technology that we've created, that this is an easy way for traditional firms to understand the merits and the benefits of digital assets and to tiptoe into the marketplace, right? You mentioned, earlier in our chat about, some of the work that's happening on some of the other different blockchains and how, there's that convergence between TradFi and digital assets on, let's say, Provenance's HELOC business, right? There's no reason why the folks that are actually transacting, in HELOC right now shouldn't be using this instead of traditional banking rails to settle product, right? And I think that's one example of where I think you're going to start seeing convergences, whereby the traditional firms themselves recognize the benefits of blockchain technology, pairing that with a regulated asset, and then ultimately recognizing that this is something that just kind of mitigates their risk off-chain because it accelerates the amount of time for finality and reduces that T+2, T+3 risk that enters into their equation every time they enter into a transaction.
I mean, one of the things we learned with the Genius Act, and again, having one out of Alex Thorne at Galaxy on, Galaxy, of course, being another one of the partners here with LYNQ, they were talking about how one of the pushbacks with some of the stablecoin bills and provisions was that, the banks were scared, right? And the banking lobbies were saying, like, if you really have interest-bearing stablecoins, you're essentially going to put a lot of the banks out of business. Where does LYNQ kind of stand in that? Like, is this going to be competitive with banks, or are the banks going to be customers? Like, how do you think about sort of as this grows and the integration? Meaning, like, is this going to be a full replacement of settlement networks, or is it complementary?
Yeah, I think it's going to be complementary. I mean, the first starting point is that, like, broker dealers themselves can't custody cash. So right away, you're going to need a banking partner no matter what. And in this scenario, we chose US Bank, who we worked with in other different implementations through the labs initiatives that we've done. But I would say that there's also a role for, let's say, the tokenized deposit network that exists at Customers Bank. right? They've got a cap. That's one of their problems, as you know, is that they can't have more than $2 billion worth of deposits on that platform. So you've got that natural end of day Jenga, as it's called in the industry, where people are, pulling positions off, right? And people are, liquidating fast. And there's just a furious amount of wires that are going back and forth to make sure that they are maintained below that cap. Well, I think that there'll be a place whereby folks will be going back and forth between, kind of customers bank and ultimately with our platform on Link. But I also know that there's, from the conversations we're having, that there are going to be logical synergies that exist on off-time banking hours, whereby stablecoins are going to play a tremendous role in what we do. Right. So I don't think that we're putting anyone out of business. I think that, kind of our solution fits nicely into a gap that's been created. And I think about banks, I think about stablecoin issuers, I think it's complementary. And, one of the places where the stablecoin issuers are going to really play a role, like I said, is going to be when, US banking hours are closed. And folks do need an off-ramp from the platform, and you can send T-Fund tokens on platform, and then ultimately through a different, kind of issuance platform and or blockchain, one can then send, stable tokens out to satisfy that natural obligation.
Yeah, makes sense. All right, well, wrapping up here, I think one of the things interesting here about Link too is, in my opinion, sort of aligns with the ethos of the digital asset industry. You've got decentralization, transparency, shared success in the form of the Treasury fund actually having interest going to the holder of the asset rather than the intermediary. So it's nice to see that. I think that's, again, one of the things that we've sort of been lacking in this TradFi crypto integration. As we wrap up here, though, any key takeaways you want the audience to know, or how do they find out more information? How do they start using this? When do they start using it? What's the closing line here?
Yeah, absolutely, Jeff. So first of all, you can find more information at link.network. We put out a series of releases since the last 4 weeks. We announced the business ourselves. Stay tuned. There's a ton more coming on that front, which will talk to the additional partners and use cases that we're building out already. Anyone's got any questions, you can find me directly, through the website. Our launch plan sounds something like this. Next couple of months will be testing. We're working with our partners to make sure that the flows are accurate. Our expectation is that we'll have a live product out and running between the next 3 and 4 months, and can't wait to continue on this path in order to solve for the inefficiencies in the market with reference to settlement.
That's great. So Link spelled LYNQ. It's link.network. JD, thanks for joining. Again, for those who want to get more of a market recap, I'll say go to our blog on our website, ar.ca/blog. You can read about what happened in the market this week, why we continue to go higher, as well as a lot of information on Arca Labs and Link there as well. So Jerald, David, thank you for joining me. The new CEO of Link. Excited to see where that goes from here. And We'll be back next week with more market stuff. So JD, thanks again. Talk soon.
Great, Jeff. Thank you.